I want to try something a little different today. I want you to close your eyes. No, seriously, just for a second. Imagine you're standing in the middle of a trading floor, Lower Manhattan. The date is February 5th, 2026. And the time. It's exactly 2:47 p.m.
The witching hour.
Right.
Okay.
And if you look around at the traders, the guys in the fleece vests, everything looks normal. They're drinking coffee, staring at screens, maybe checking some sports scores, and then the stock market is just humming along. But if you could see into the walls, if you could somehow look inside the fiber optic cables running under the streets of New York, you'd see absolute sheer panic.
It wasn't a crash. That's not the right word. It was more like a seizure. The invisible plumbing that moves trillions of dollars around the American financial system,
Yeah.
it didn't just slow down.
Yeah.
It just stopped.
At that exact moment, the overnight repo rate, and, hang with us, we are going to explain why this really boring number is actually the scariest thing on earth. It usually sits at, a sleepy 4.5%? But on that afternoon, in the U.S. markets, it didn't just tick up. It screamed. It went from 4.5 to 5 to 7, and then it hit nearly 10%.
Which, for anyone who doesn't follow this stuff, is, well, it's basically a mathematical impossibility in a healthy market. That's like water suddenly deciding to boil at room temperature. It defies the laws of financial physics.
And here's the part that really gave me chills when we were digging into this. While that rate was exploding, 14 major U.S. financial institutions, we're talking about the absolute pillars of American banking, they secretly rushed to the Federal Reserve's emergency window. They were desperate. They needed cash, and they needed it right now.
And that's the highest number of panicked banks since the Silicon Valley Bank collapse back in 2023.
Exactly. And that is why we're here. Because while the rest of the world was watching the stock market hit all-time highs, the very heart of the American financial system skipped a beat. A huge beat. And the question is, was that just a little flutter? Or was it the warning for a massive cardiac arrest? So we are doing a deep dive today into what we're calling the day the money stopped. We've pulled together insider reports, a ton of trading data, private analysis on this whole event. And before we go any further, I want to make one thing crystal clear for everyone listening.
This is really important.
We are talking about the United States. We are talking about Wall Street, New York, and the American banking system. This is not about the bank down the street from you here at home. This is a story about the engine room of the U.S. economy.
Exactly. But, and this is the big catch, because the U.S. dollar is the reserve currency for the entire planet, if the engine in New York seizes up, well, the shockwaves travel everywhere. If Wall Street catches a cold, the rest of the world can end up in the hospital.
So our mission today is to turn this terrifying financial signal into a story about trust, about cash, and what actually happens when the bankers run out of money. It sounds like a thriller because, honestly, it kind of is.
It is the ultimate financial thriller. They have a name for it. They call it a liquidity event.
Okay, so let's get into the mechanics, but let's keep it simple. The repo market. Every time I hear that term, my eyes just glaze over. It sounds like something for accountants. Why do you call this the most dangerous market in the world?
Because it's basically the pawn shop that keeps the global economy alive. It's a market worth over $4 trillion that has to reset every single night.
A pawn shop. That's a pretty vivid image for high finance.
It's the best analogy, I think. Imagine you're a massive American bank. You've got billions of dollars in assets, right? Well, let's say U.S. Treasury bonds. These are super safe. They're valuable. They're like a gold watch. But you have electricity bills to pay tonight. You have staff to pay. You have trades to settle. You can't pay your electric bill with the Treasury bond. You need cold, hard cash.
So I'm rich on paper, but I'm broke in actual cash.
That's it, exactly. So you enter the repo market. You go to another bank or maybe a money market fund and you say, here's my gold, watch my bond. Lend me cash overnight. I promise I'll buy the bond back from you tomorrow morning for a slightly higher price.
And that little difference in price, that's the interest rate.
That's the interest, yeah. Repurchase agreement. Repo. And usually this is automatic. It's boring. It happens millions of times a day without anyone thinking about it. But on February 5th, something in New York just broke. When the U.S. banks walked into the pawn shop with their gold watches, the lenders looked at them and just said no.
They just said no.
Either they said no or they said, look, I don't really trust you right now. If you want this cash, I'm not charging you 4%. I'm going to charge you nearly 10%.
That's not just business. That's fear. That's panic.
It implies absolute terror. When the rate spikes that high, It means American banks are hoarding cash.
Yeah.
They're hugging their dollars tight because they suspect that the guy asking for a loan might not be around tomorrow morning to pay it back.
And this connects to something we saw in the research, this idea of the liquidity cascade. It's a fascinating concept. It basically says markets don't die because the economics are wrong. They die because the trust just evaporates.
Precisely. You can have a solvent business. You can own a skyscraper in Manhattan. But if you owe $100 million today, and you can't turn that skyscraper into cash instantly, you are bankrupt by lunchtime. That's liquidity. And on February 5th, the gears of that machine just locked up tight.
So the obvious question is, why? Why now? Why February of 2026? What is going on inside these U.S. banks that made all the lenders so incredibly nervous? I mean, usually these places are seen as the safest institutions in the world.
It comes down to one number. It's a massive, terrifying number. $6.8 trillion.
That's a lot of zeros.
It's the estimated amount of unrealized losses that are just sitting on the balance sheets of U.S. financial institutions.
Yeah.
This is the elephant in the room that everyone on Wall Street is trying desperately to ignore.
Okay, let's unpack that. Unrealized losses. We hear that term, but I want to understand the trap. How do you lose almost $7 trillion without actually losing it?
It's a bit of an accounting magic trick.
Yeah.
Okay, think back to the 2020, 2021. The U.S. Federal Reserve had interest rates at basically zero. So American banks were just swimming in cash from all the government stimulus money. They had to park that money somewhere safe. So what do? They bought U.S. government bonds.
Right. Safe, boring, reliable, the safest asset on the planet.
Usually, yes. But those bonds paid practically nothing in interest, maybe 1% if you were lucky. So fast forward to today. Inflation hit the U.S. economy hard, and the Fed jacked up rates like crazy. Now, if you buy a new U.S. bond, it pays, let's say, 5%.
So nobody wants my old crummy bond that only pays 1%.
Of course not. Why would I buy your bond paying 1% when I can just get a brand new one that pays 5%? So the market price of your old bond just collapses. If you tried to sell that old bond today, you wouldn't get the full price. You might only get 70 cents on the dollar.
But as long as I don't sell it.
As long as you don't sell, you don't have to report the loss. It's unrealized. It's a little fantasy. You can pretend the bond is worth 100, even though everyone knows it's really worth 70. You just hold on to it and smile.
Right.
But, and here is the trigger for the crisis. If you suddenly run out of cash,
And you're forced to sell.
the fantasy is over. You sell the bond, you take that 30% loss, and boom, suddenly your capital is wiped out. You're insolvent.
So on February 5th, the lenders in the repo market, they looked at these big U.S. banks and thought, wait a minute, you guys are sitting on a mountain of these hidden losses. If I lend you money and you go bust tomorrow, I'm going to be stuck with your bad bonds.
Exactly. It's this squeeze from both sides. You have the U.S. Federal Reserve doing something called quantitative tightening. They're literally sucking cash out of the system to fight inflation. And at the exact same time, the U.S. Treasury is issuing trillions in new debt to pay for the government deficit.
It's just supply and demand.
The supply of cash in America is shrinking. The demand for cash is exploding. And the collateral, those old bonds, is starting to look really questionable. That is why the rate spiked to nearly 10%. It was the system screaming, there's not enough money.
It's so disturbing how this stuff is cyclical. Our research team pulled up these comparisons to 2008, which we all remember, but also 1931. Let's start with 2008. Everyone thinks of Lehman Brothers as a bad mortgage story.
Yeah, that's the movie version, The Big Short. But that isn't really the mechanics of how it died. Lehman Brothers didn't die because some homeowner in Florida missed a mortgage payment. Lehman died because the repo market froze on them.
The pawn shop closed its doors.
It slammed them shut. Lehman was incredibly reliant on this overnight borrowing just to fund their daily operations. On the weekend they failed. Their lenders, J.P. Morgan and a few others, they demanded more collateral. They basically said, we don't trust your assets anymore. Lehman couldn't come up with the cash.
And what's really scary is that the warning signs, these little spikes in the repo rate, failed auctions, they started appearing about 90 days before Lehman actually collapsed.
And we are seeing those exact same tremors now in 2026. That spike to 9.2%, that is the tremor. The question is, how far away is the earthquake?
Wow. Now, 1931, that's a deep cut. Credit-Anstalt, why are we talking about some Austrian bank from almost a century ago?
Because it teaches us about speed. We tend to think banks fail slowly over time. Credit-Anstalt was the biggest bank in Austria. When it failed, it didn't just hurt Austria. It triggered a chain reaction that took down banks in Germany, then the UK, and it made the Great Depression in the US so much worse.
It went viral before the internet even existed.
It did. And it proves that liquidity crises are always faster than solvency crises. You can spend months arguing about whether a bank is solvent based on its messy loan book. But liquidity. Liquidity is binary. Do you have the cash to open your doors at 9:00 a.m.? It's a yes or a no.
And if the answer is no, you're dead.
You are dead. And in a digital age where you can move billions with a mouse click, bank runs don't happen in lines on the street anymore. They happen in nanoseconds. That's the lesson from 1931, but it's updated for 2026. When confidence goes, it goes instantly.
I want to play devil's advocate for a second. Let's say I'm not a hedge fund manager. I'm not running a bank in Manhattan. If American banks are fighting with each other over overnight interest rates, why on earth does that change my life? Why should the average person listening to this right now even care?
Because of something called the credit crunch. This is the contagion. When U.S. banks are terrified to lend money to each other for one night, they absolutely stop lending money to the real economy for 10 years.
So we're talking mortgages, car loans, small business lines of credit.
Everything stops. And we are already seeing the data in the United States. Auto loan delinquencies are ticking up. But look at commercial real estate. If you want to get a loan for an office building in Chicago or New York right now, good luck. The window is basically closed.
And if American businesses can't get credit?
They can't buy inventory. They can't make payroll. They start firing workers. Then those workers stop spending. It creates this awful feedback loop.
Yeah, the research points out that U.S. credit card charge-offs are rising really fast, so the American consumer is already stretched thin, and now the banks are about to turn off the tap.
And you have to remember, this stuff is global. If the U.S. engine stalls because of a clogged pipe in New York, the U.S. buys fewer cars from Germany, fewer electronics, fewer chips from around the world. The plane gets exported immediately. We end up feeling it right here.
Okay, that's the doom and gloom. It feels heavy. But this show is about making you smarter, not just scaring you. We found a section in the research, it's called the Playbook, and it outlines what they call 3 asymmetric plays for this exact environment.
Right. Asymmetric is just a fancy word that means low risk, but high potential reward. It's about protecting yourself when the giants are starting to stumble.
Okay, so play number 1. Cash is king. This feels weird because for the last 5 years, all we've heard is cash is trash because of inflation.
In a normal market, cash is trash. But in a liquidity crisis, cash is oxygen. When the banks panic, they sell everything to get dollars, stocks, crypto, gold initially. Everything crashes together because all that matters is getting liquid.
So if you're the one sitting on the cash,
You're the shark. You get to buy assets for pennies on the dollar. But the insiders are very specific here. They suggest short-term U.S. Treasury bills or fully insured accounts. You don't want to lock your money away for 30 years. You want it liquid. You want it available tomorrow.
Got it. Okay, play number 2, physical gold.
This is the insurance policy. And you really have to understand the why here. It's not about the price going up or down. It's about something called counterparty risk.
Unpack that for us. Counterparty risk.
Well, if you have money in a bank, that money is technically a liability of that bank. You are trusting them to pay you back. If you own a stock, you're trusting the exchange and the broker. Those are all counterparties.
And if they fail, you're just another person standing in line with the lawyers.
You're just a creditor. Exactly. Physical gold doesn't have a counterparty. It's not someone else's promise or liability. It just is. If the digital banking network freezes or the power grid has issues, gold is still gold. It exists outside the system.
The notes mention 2008 and 2020. Gold actually dropped at first in those crises, right?
It did, yeah. In the initial sell everything panic, gold dropped because big funds had to sell it to cover their losses somewhere else. But immediately after that initial shock, it rallied, and it rallied massively. It was the ultimate safe haven once the dust settled.
Okay. Play number 3. This one is called the Vulture Strategy. It sounds aggressive.
It is. This is for the risk takers. Look, if this crisis in the U.S. really plays out, financial stocks, banks, insurance companies, they're going to get absolutely slaughtered. They will trade at valuations we haven't seen since the Great Depression.
So you buy them now?
No, absolutely not. You never try to catch a falling knife. You wait. You wait for the absolute peak of the panic. You wait for the magazine covers to say, is this the end of banking? That is when the vultures swoop in. You buy high-quality assets when everyone else is literally throwing them up, but you have to have a stomach of steel to do that.
It really sounds like timing is everything.
It is. And right now, the signal from February 5th is just Caution. We aren't at the bottom yet. We're just seeing the first big cracks in the dam.
So let's bring it all back to that one moment in New York. The red light is flashing on the dashboard. The plumbing is clogged. What happens next?
Well, the U.S. Federal Reserve is trapped. They have two choices, and frankly, both of them are bad. Choice A. They can print trillions of dollars to bail out the banks. That fixes the plumbing, but it sends inflation in America skyrocketing again.
Which just crushes the consumer and makes everyone furious.
Right. Or choice B. They keep fighting inflation, they keep interest rates high, and they let the banking system face the consequences of its bad bets.
Which risks a total systemic crash.
It's a rock and a very hard place. And that near 10% spike tells us the system is screaming under the pressure. It cannot hold this pose for much longer.
It's a pretty sobering thought, isn't it? Most people are looking at the stock market making all-time highs and thinking the party's just getting started. But the smart money, the guys who actually run the plumbing on Wall Street, they just rushed for the emergency exits.
The system had a minor heart attack.
Yeah.
And the doctors, the central bankers, they managed to stabilize the patient for now. But the underlying disease, it hasn't been treated at all.
So was February 5th just a glitch in the matrix? Or was it the beginning of the end for this entire financial cycle? That's something for you to think about next time you check your banking app.
Keep your eyes on the boring numbers. That's usually where the truth is hiding.
Thanks for joining us on the deep dive. Stay curious, stay skeptical, and we will see you next time.
Take care.